Let's be real. Having $100,000 in savings feels like a win, right? But here's the hard truth. If all you're doing is parking that cash in a savings account, inflation is eating it alive. While you're earning a measly $500 in interest, the real value of your money drops by $3,000 every year. So here's the question. Are you going to sit back and watch your money shrink? Or are you ready to make it grow into millions? In this video, we're diving into two of the hottest ETFs in the game, QQQM and SCHD. I'll break down their strategies, risks, and how a $100,000 investment in either one could transform your financial future. Spoiler alert. By the end, you'll know how to build a portfolio that could pay over $300,000 annually in dividends. Sound good? Let's dive in. First, let's talk about the elephant in the room. Why saving alone is a losing game. Inflation. On average, inflation runs at 3% annually, which means that every year, the purchasing power of your $100,000 shrinks. Sure, a savings account might give you a 0.5% interest rate, yay, $500, but that still leaves you $2,500 behind inflation. Here's the kicker. Over 10 years, that $100,000 could feel like $74,000 in today's dollars. But if you're smart about investing, if you put that money into the right ETFs, your money doesn't just keep up with inflation, it can grow exponentially. Which brings us to the stars of today's show, QQQM and SCHD. So, what exactly are QQQM and SCHD, and why are they such popular picks? Let's start with QQQM. This is the Invesco Nasdaq 100 ETF, a more affordable sibling of the famous QQQ. It focuses on 100 of the most innovative companies in the Nasdaq index, including Apple, Nvidia, and Microsoft. Think of QQQM as your ticket to riding the tech wave into the future. Now, SCHD, on the other hand, is like the reliable older sibling. It's the Schwab US Dividend Equity ETF, packed with high dividend-paying stocks from industries like finance, healthcare, and consumer goods. It's built for stability and income, perfect for those who love cash flow without all the drama of the stock market rollercoaster. In short, QQQM screams growth, while SCHD whispers stability. But the devil is in the details, so let's dig deeper. QQQM is a concentrated beast. Over 50% of its portfolio is in tech, with giants like Amazon, Tesla, and Meta leading the way. This means explosive growth during market booms, but here's the catch. It also means major losses if tech takes a hit. Remember 2022? Tech stocks plummeted, and QQQM felt the pain. Now SCHD plays it safer. Its largest sector is financials, followed by healthcare and consumer defensive stocks. Instead of chasing trends, it focuses on solid, dividend-paying companies with strong fundamentals. Its diversification helps smooth out the wild market swings. In other words, SCHD is the tortoise to QQQM's hare. But as we know, sometimes slow and steady wins the race. Let's talk numbers, because performance matters. Over the past year, QQQM delivered a jaw-dropping 32% return, thanks to tech's rebound. In comparison, SCHD posted a respectable but modest 18%. Zoom out to the last 5 years, and QQQM continues to shine with a 77% return, nearly doubling SCHD's 50%. But here's where it gets interesting. Over the past 10 years, SCHD delivered a solid 114% return, highlighting its long-term reliability and compounding dividend growth. Here's the takeaway. QQQM crushes it during bull markets, but SCHD is your safety net during downturns. Your choice depends on how much risk you're willing to take. Now let's talk about what SCHD is famous for: dividends. This ETF boasts a juicy 3.39% yield, meaning for every $100,000 invested, you're getting $3,390 a year in payouts. And the best part? Its dividends grow at an average rate of 11% annually. Reinvest those payouts, and you've got a compounding powerhouse. QQQM, on the other hand, isn't built for dividends. Its yield is a tiny 0.63%. While its dividend growth rate is a strong 23%, it's starting from such a small base that it doesn't make a huge impact, at least not for decades. So if you're looking for immediate cash flow, SCHD is the clear winner. But if you're focused on capital growth, QQQM is still in the game. Alright, here's what you've been waiting for. What happens if you invest $100,000 in QQQM or SCHD and let it grow for 30 years? Let's start with SCHD. Factoring in share price growth, reinvested dividends, and its 11% dividend growth rate, your $100,000 could grow to $4.4 million. And here's the kicker. Those dividends could pay you $36,000 a year by the end of it. That's a stable income stream you can retire on. Now QQQM is all about aggressive growth. Over 30 years, your $100,000 could balloon to an eye-popping $9.4 million. But here's the catch. Dividends would only bring in about $8,300 annually. Almost all the growth comes from share price appreciation, which means you're riding the tech roller coaster. So, which one should you choose? It all depends on your goals. If you're chasing growth and can stomach the highs and lows, QQQM is your ticket to potential millions. But if you value stability, income, and a solid dividend strategy, SCHD is the smart choice for long-term wealth. The truth is, no ETF is one size fits all. Your investing style, risk tolerance, and financial goals should guide your decision. Either way, $100,000 is a powerful starting point. Make it work for you. If you want to learn how to start investing with even $10,000 and still hit these goals, click the video on your screen right now. Don't forget to like, subscribe, and comment below with your ETF of choice. Are you Team QQQM or Team SCHD? Let's build wealth together.